Inflation have risen to 5% year over year in the US last month, against the Fed's 2% inflation target. And so far, there has not been a single day in 2021 where I have not come across a piece of news that involved inflation. Almost everyone is talking about it. And that is because inflation is one of the most important components of having a stable economy, which is the main mandate of central banks. It can literally take you from selling goods for money to finding ways to get rid of money. Here is a photograph from a 3-year-old Guardian newspaper of some Venezuelans turning cash, which was basically worth nothing, into some sort of useful objects that perhaps they can sell or exchange. It may seem dramatic, but it has been the reality of this Latin American country. Inflation is simply a percentage increase in prices of goods and services in a country. For advanced countries like the US and the UK, that number is expected to be roughly 2% every year. But when things go out of control and a country enters into hyperinflation or an extremely rapid increases in prices, you can see situations like we saw in Venezuela, where you can be expected to pay 2.6 million bolivars for a toilet roll paper or 14.6 million bolivars for some chicken. Just imagine carrying that much money into your weekly grocery shopping. Anyway, this video is not about Venezuela or hyperinflation, but what to do when inflation does run higher for longer. Before moving over to answer that question, let's first understand what is the typical high level of inflation that we can realistically expect to impact most of us. So just to be clear, we're not talking about seeing inflation going up to 100% or 1,000%, or price of coffee going up from £3 one year to £33 in the next year. We are, however, talking about inflation rising up above 2% and maybe close to 3% and remaining at that high level for a foreseeable future. Because even a high and persistent level of inflation of 3% or higher will have some impact on us, because it is the job of the independent central banks to keep that number around 2%. So the idea is this: if we consistently see the annual inflation figure going up above 2% month after month, it will trigger the central banks to become more hawkish and start rising interest rates. We call this tightening of the monetary policy. This is a very important part of the messaging that the central banks like the Fed is trying to convey to us. They keep mentioning things like, oh, don't worry about this high inflation number that you're seeing at the moment, these are all transitory. And whether inflation is in fact transitory or not will impact what you should be doing and how you should be managing your money. When all the economists and policymakers are using the word transitory, what they really mean is that the high inflation number is not permanent and it is of a short-term nature. They have to reiterate this message because this month the US reported annual inflation figure of 5% as measured by the CPI or Consumer Price Index. But here is why this number is only expected to be transitory or only be high over the short term. Number one, technical reasons such as the base effect. Remember that the inflation figure is a percentage term, so it really depends on where you're calculating your percentage number from. In other words, the base number. Since the nature of COVID crisis meant we literally could not spend our money as shops were closed, inflation data that was reported 1 year ago was already pretty low. And when you do a simple percentage increase from a low base or a low value, you automatically get a higher number. So the understanding is that once we all start to settle down in a post-COVID world and resume back to our normal spending habits, the current high inflation number that we are seeing at the moment will not be so high in a year's time, because we're already spending a lot at the moment and the base number or the base value of the CPI index is going up. So the 5% inflation you're seeing now for the May number, you should not be seeing that again next year in May. And the second reason is to do with supply disruptions, again COVID related. What is going on currently in the world is a huge supply-demand mismatch. The pandemic impacted every single part of the supply chain you can think of, from sourcing of raw materials such as oil and metals to selling goods to consumers like us. This meant that prices of some of these raw materials or commodities that gets used in production of goods were pushing higher. And this is increasing the overall cost of production for producers and also to us, the consumers. A higher commodity prices directly impacts us, the consumers, because if you look very closely as what makes up inflation or the CPI index, you'll see that at the moment a high increase is in fact coming from these commodities. And number 3, excess demands. So the reason why inflation is likely to be short-lived is because right now we literally have too much savings and too much money floating in the economy thanks to the stimulus by the governments. Governments all around the world, especially the US, handed out generous help in forms of checks or job protections for their people, which in aggregate meant that in total, not just looking at me or you, but in total, we have saved up a ton of money that we have not spent last year because we had to delay our holiday or we didn't really have anywhere to spend. Did you know that when shops in the UK did reopen again in April this year, we have seen a 90% increase in clothing sale? Now, can you really expect to see a 90% increase year after year in clothing sales in the future? Realistically, not. And so if that sort of pattern in high spending does not really continue year after year, that means we're unlikely to see a higher inflation year after year. So in a nutshell, as we start to see all these little intricacies around how the mechanics or the dynamics of economy works, and we start to see a lot of settling down in our spending habits and our behavior and our expectations of inflation, we can start to see a much more stable number going forward. But the main part of the video was all about what to do or how to invest if inflation does remain high and stays like that for a long time period. If that happens, well, firstly, stay out of cash. If I were to think of different asset classes and their vulnerability to inflation, then I start off with cash. Try to minimize your holdings in paper money like cash because its purchasing power will definitely be decreasing by the inflation amount. Next, you would also want to avoid fixed income products like bonds unless they are inflation linked. High inflation is bad news for bond investors, and it tends to hit the bond market first. Because when you purchase or invest in a bond, you're automatically locking yourself to the fixed interest that you can expect to get from that bond as long as you hold it. And so very intuitively, it will not be able to keep up with the rising inflation. So if you think about investing in a bond that pays you 1% nominal interest rate, but inflation rate is at 3%, then you are automatically guaranteeing yourself a negative 2% return. Next, it is going to hit the stock market. Well, different parts of the stock market will be impacted differently depending on how sensitive they are to the rising inflation rate. But ultimately, they will also be impacted. I have a separate dedicated video to inflation and the stock market. Feel free to check that one out later. Now, on the other side of the coin, you do have certain types of asset classes that will fare much better in a rising inflation environment. We call these real assets. They are called real assets because they have a direct link to a tangible asset or a commodity. For example, real estate, other commodity investments like gold and oil. Since inflation generally means prices of things going up, so when you do invest in a property and say you rent it out, you can also expect to see your regular cash flow also go up with inflation because it is much easier for a landlord to increase rent for their tenant. Even if you don't buy a direct property with your money and lend it out, you can also invest in property funds. What they will do, they will have lots of underlying investments into different types of property, like it could be residentials, it could be offices, it could be a storage space. And what those companies will do is that they will start to increase the rent that they will charge from the people that is occupying their property and automatically pass that on to you and in forms of dividends, for example. So property investments directly or indirectly through REITs is something that you can also consider if you worry about inflation rising and staying high. As well as properties which can really help with hedging inflation risk, you can also think about commodity investing as well. And the reasoning is very intuitive. If you think of the inflation basket such as the CPI or Consumer Price Index, as I have just showed, a key component of it is energy, which is a commodity. So when price of energy goes up, the CPI index goes up, which means inflation is going up, But if you also invest in it, or if you invest in this energy sector, then that means that your investment also goes up. Aside from different asset classes and how sensitive they are to inflation, one major tip that I must give you is to well diversify your portfolio, especially during a high inflation scenario. Because the key thing to remember is that different sector or different country, they will not have the same level of inflation. Some countries will run with a much higher inflation, like we saw in Venezuela, and then there will be certain countries that will be moderately below the 2% target, like usually in Europe. And then you have the US, which is currently running a little hot, but hopefully this will only be transitory and it's not going to stay that high for much longer. So being able to diversify your money across different regions, different countries, means that if one country does have huge impact or a negative impact from inflation, not all parts of your portfolio will get the similar sort of hit. So diversify. A very simple one, but a very effective one. But aside from money and investment related stuff, let's just very briefly tell you about other things that you can do when you think that inflation is here to stay. First thing you can do is hunt for a better bank account. Even though interest rates are at all-time low, different bank accounts can offer you different types of investment product for cash savings, which might be marginally better than what your current bank is offering you. So it's always good to, look around for a better deal or a high interest savings account where you can save and tuck away some of your cash for those emergency funds. And secondly, it might be a really good time to get into a good debt. By good debt, I'm not talking about, of course, not talking about getting into credit card debt or getting a loan from the bank. By good debt, I'm talking about something that might be tangible and tied to a good commodity or an asset like property. So like a home mortgage. If you're thinking of buying a property, it might be a good time to get into a home mortgage for yourself. Because remember, right, if you're thinking about inflation, when you get a mortgage from a bank, you are again fixing the amount of interest rate you're paying to the bank, right? So they cannot suddenly, if inflation, for example, stays high at 5% for next 2 years, the bank cannot suddenly come back to you and be like, oh, we've done a bit of a miscalculation and we're not gonna charge you 2% for your interest in your mortgage. You're gonna have to increase that and start to charge you 3% because inflation is high and we want to pass on that inflation cost. They cannot do that because you're directly in a contract with them in a fixed mortgage, right? So that's a really good thing. But think about it. If you're renting at the moment, you don't have any upper hand on that. If inflation is high, which means cost of living being high, then your landlord, they can come back anytime and be like, you know what, this from next month onward, you're gonna have to pay me £50 extra in your rent because the cost of living is high and you just have to, I just have to pass it on and you have to increase your cost. So you don't really have an upper hand when it comes to this, but if you do get into a mortgage property, then you can actually fix that cost with the bank. Finally, keep an eye on those recurring bills. Because remember, the one thing that is definitely true with inflation is that the prices will be increasing. It starts all the way from the start of the supply chain when companies are producing their product all the way to the shelves where we, the consumers, are buying it from a retail shops or buying it online. And so when the price of input costs are rising, the companies will try to pass on that higher cost all the way to their consumers. So the producer will pass it on to the retail company, who will then pass it on to us, the end customer. So some company will definitely try to pass on all the costs to you, thinking that you would be happy to pay the increase in cost. So definitely shop around and keep those eyes open to find better deals for your regular expenses. Well, that's all for today, everyone. I hope you found this video useful, and until next time, look after yourself and your money.